Hey, everybody. Welcome to week 154. And I still giggle a bit every time I think about it. Like 2 weeks is what we were thought. So anyway, here we are 154 weeks later. Adam is off today. I don't even actually know where he is. I just know that he's off and he's probably with his family somewhere. So that's great. So the company is continuing on without him today. The webinar will continue on without him today, and we'll welcome him back next week. But we do have a very special guest. We have Andrew Bosserman with Shoemaker Law, who was an IRS agent, so a former IRS agent, and he is a tax attorney at Shoemaker Law. And we'll get into some more of his stuff. Oh, what? Adam is on? I thought you were off.
Nah. I thought I'd be here for moral support.
Oh, you're so good like that. That's awesome. And then Jack said he'd be coming in on 2 wheels. So, and I'm assuming that's 2 wheels, you know, with a car like this, not necessarily on a scooter like what I have. So anyway, well, good to have you. Where are you dialing in from, Adam?
I'm currently in my kitchen. I'm actually not leaving until this afternoon, but I had a call. I had a call, ironically, with the topic with the IRS this morning. And I know Andrew will be surprised to hear this, but the freaking agent didn't show up.
What?
Yeah.
Is that like when you get a speeding ticket in South Carolina and you decide that you're going to go ahead and fight it, and you go down to South Carolina on the appointed date and the trooper doesn't show up? Is that the same thing, Andrew?
Sounds pretty similar, yeah.
Yeah, the only difference is in my scenario, they don't say case dismissed. You know, they say case closed. You know, not in your favor. So.
Oh, really? Because if the trooper doesn't show up, it's dismissed. And
yeah, this is different. It just drags things on.
Yeah. No, I've tried with the supervisor call. Yeah, how is it fair that the agent didn't show up, agent didn't show up, and then all of a sudden it's rush. And the answer that I get is, I don't care. Effectively. So.
Wow. Okay. Well, we have some polling questions today, which will be fun. And as everybody's ramping on here, please hit us in the Q&A if you have questions. And we are going to be asking for some participation in some of these questions. And I'm laughing because I wrote them, and there are some funny answers. So you'll be able to figure them out. But funny answers to some important topics, because these are all questions that we answer all the time, and Adam gets it all the time. So as you're doing that, you can still harass us on the chat. And I don't see, I'm going to look here, see if Papa Joe's on, because he usually is pretty good like that. I don't see Papa Joe. Nope. So he'll have to listen to the recording. Hey, before we dive into this, a couple things that are important. One, on the 20th, we've got Charlie Maloof, we've got Patty Comer. So Charlie Maloof is the CEO of Ashley Home Stores. Patty Comer is one of the co-founders of Accrue Partners. And then we've got Kevin Monahan, who does a lot of retention strategies, and we're talking about talent retention. And so we're going to be doing that at BGW, where I'm dialing in from today. We've got, I think, 40 slots, and I think we've got about 30 that are registered or more. So if you want to know how to register, ping me, hit me up on my email, which is gfrey@trustbgw.com. And I'll make sure that you get that. Also, April 25th, if anybody is trying to think about, hey, how do I head off this recession that they keep talking about by increasing sales, April the 25th, we're doing a seminar here at BGW with BGW Growth, our Sandler franchise. That's Jim Dunn, as well as Dan Flaherty. And that is $99. But if you use this code, dial 99, I'll put it in the chat, you can get in for free. And we want to fill the room on that one too. So anywho, let's go ahead and get this party started. Well, first of all, since you're on, do you have any rants that you want to talk about before we dive into IRS confessions?
Yeah, so keeping in mind that I'm a libertarian, Gary.
You always, you always hide behind that.
So I watch, it's not hiding, it's just the truth. So
okay, all right, cool.
This is just, it's related to the upcoming budget crisis and you know, triggering the borrowing threshold. So I did actually watch most of the 60 Minutes interview with Marjorie Taylor Greene. And while so here's what I didn't like about it. What I didn't like about it is that, in class, you got to own the fact that, you own your freaking social media presence. Placing the whole, well, I didn't post it, someone from my team posts. It's like, take a little freaking responsibility.
That is true.
and be account, like that kind of stuff was BS and continues to be BS in my opinion. However, what I was extremely impressed by, and I came across as like, I actually believed what she said. I believe that she believed this, is that, and it is very aligned with what I believe too, which is both parties have gotten us into this mess.
Yeah.
So, Leslie Stahl really kind of pinned her down, because she started down the whole, Joe Biden, created this whole problem mess. And Leslie Stahl was like, yeah, but I mean, Republican administrations, including Trump, ran up pretty big budget deficits too. It's like, no, both parties, all sides, and I'm like, thank you, thank you for that. Thank you for saying that. So it's just a reminder as we come up to this, as you hear a bunch of ranting about, all this runaway spending and tax rate increases and all that kind of stuff, is just that, it's true. Spending has run away. And we have not had a balanced budget since Bill Clinton and Newt Gingrich. And just roll back the clock and think about what tax rates looked like then. They were higher than they are now. Right? So, that's just and it's gonna take responsible adults to actually, and we may have none in Congress. It's gonna take responsible adults to actually do something about it. And the solution will likely be painful for a lot of people, because that's what one of the few things that I do agree with Kevin McCarthy in his statement about comparing the budget deficit to household debt is that, clawing your way out of debt is the same as trying to raise your GPA after you tanked it. Sorry, Gary, I won't swear. It freaking sucks. It's hard. And it requires painful sacrifices. Like, I don't get to go out to eat dinner when I want to. Maybe I don't get to go on the vacation that I want to. So it requires some painful choices that I just hope, I hope we make. So it's just a, to our listeners out there, anybody that listens to this, just a reminder that it's like, hey, pox on both their houses. Both parties got us in this mess. It hasn't been balanced since the mid 90s, and it's probably, and it kind of just further reconfirms that when I hear Marjorie Taylor Greene saying, yeah, both parties created this mess, it actually gives me hope that maybe people are waking up to the realization that there's going to have to be bipartisan solutions that are very painful for all of us to get back on on good, solid financial footing. So ran complete, Gary. Sorry about that.
That's really good. Very good. And Jack has joined us. Good to have you, Jack. But you're in good hands with.
There he goes. Yep. Had to do it. Had to
Now
do
you
it.
know where
Had
I'm
to do
at.
it.
Sorry. Tried to talk my way out of it. Got stuck here again.
Oh man, not good. So I'm going to go ahead and launch first of all, in the chat for anybody, dial 99 is the code for the April 25th dialing in your sales event at BGW. So if you need additional information on that, if you're not on our mailing list, let me know, gfry@trustbgw.com. So I'm going to go ahead and launch this poll. All right. So the first question is, what should you do if you or your CPA makes a mistake on your tax return? Answer number 1, amend the return. Number 2, file a superseding return. Number 3, do nothing. Number 4, move to another country. Now that I wrote just in honor of Papa Joe, and unfortunately he's not on. So if you would vote, what do you think you should do? Because Andrew is going to go and expand on that. So please vote now. Come on. We got 22 people on here. Somebody can vote. Then we'll move to the next one.
Just as a point of clarification, we don't get to vote, but I don't even see it on the screen. So I just want to make sure that actually it's going out.
Well, let's see. I wonder why. That's weird. All right, let's try it again. Poll.
He's in a pool.
Relaunch the poll. All right, here we go.
There it is.
I don't know why it didn't go. All right, there we go. Thanks, guys. A couple of you guys shot out like a cannon. Amend the return, file a superseding return, do nothing, move to another country. Everybody's so far saying amend the return. Before we move on to the next one, so we got, it's 100% amending it. So here's the question, Andrew, are they right?
So in some instances, they're probably right, but there's other things you need to take into consideration. So first of all, there is no legal requirement for you to amend the tax return. So if you make a mistake and know about it, there's no law that says you legally have to amend your return. However, there's some reasons why you might want to. Generally, filing an amended or a superseded return will prevent any penalties from being assessed, on any underpayment of tax, or if the IRS then audits you after the fact and you end up owing tax. So amended and superseded returns are great for avoiding penalties. But let's talk about the difference between amended and superseding returns. So a superseding return is essentially a second tax return filed before the tax deadline. So that is useful when, say, for instance, this year, you already filed your individual income tax return, which is due April 18th this year. You filed it, let's say, back in March. But right now you realized you made a mistake and you want to correct it on your tax return. You don't have to go through the whole amendment process. You can actually file what's known as a superseding return, where you just file another tax return with the IRS before the deadline. And I believe if you electronically file, there's a checkbox your preparer can check to say it's a superseding return. Or if you paper file, you write a notice at the top. And essentially the IRS disregards that first return and will process the second return. So that's useful in that instance. But if the deadline has passed, then you can file an amended return and correct any errors then you'll either owe additional money or receive a refund.
Man, I'm so glad that you clarified the difference because I wasn't quite sure, honestly. Now, I'm not a tax guy. So anyway, do we do that very often, Adam? Filing superseding returns?
The answer to that is no, because generally, it's going to sound terrible, but since starting the company, we've only ever been able to get people to give us about 45% of our client base actually gives us enough information to actually file the tax return by the filing deadline. So at that 45%, generally based on our tax preparation standards, we feel like we're filing a pretty darn accurate tax return, kind of knock on wood, just based on the lack of audit adjustments we get, when we are audited. So that's a long way of saying, no, because we've never had that problem. The only time anything like that has ever come up is with an individual tax return where somebody just forgot to include a new 1098 because they open up a new brokerage account. But typically that's the fix for that happens years later, because that's when they get a notice from the IRS saying, hey, what's the deal with this unreported income?
Yeah, and also often at one point clarification, if there's a math error or something minor, the IRS will often correct those on your behalf and just send you something in the mail. So there's generally no need to file an amended return for a minor error, math, something like that. And yeah, Adam's right, because a lot of times you don't realize mistakes until years later after the filing deadline's passed. I will clarify that the superseding return also qualifies or you can also do it if you file an extension. So it's either the original due date or extended due date if you file an extension. So.
All right, good. Well, let's move to the second question. So a couple of you guys jumped on it right away, but this is regarding meals and entertainment expenses. First question, I find the IRS rules to be confusing. Please clarify. Or the other option is, I find the IRS rules to be quite user-friendly and clear. So hit us up on that and vote. Some of you guys may think it's, the IRS is super clear so far. We had 4 people vote. So if you would hit that and let's see where you guys land. Come on, you guys, there's 26 of you on there. Find the button. There you go. All right. So with 5 people voting, it looks like I need to share the poll again for some reason. Are you guys able to see this thing?
I can still see it.
All right. No. Let me see. Let's try this again. Hold on. Relaunch the poll. Here we go. Okay. So we've already answered that. So go ahead and move on. Meals and entertainment. Option A. Can you guys see this? There we go. Rules are confusing. Give us some clarity. Or I find the IRS rules to be quite user-friendly and clear. And go ahead and hit us on these other questions, and then we'll deal with them in order. So that question is, rules are confusing. Please clarify on meals and entertainment. The next question is, how familiar are you with the IRS Dirty Dozen scams list? This is good because, somebody's very familiar with the Dirty Dozen. They helped co-author some of them. We want you can remain anonymous, but I'm curious as to what you helped co-author. And then the final question is what tax expertise does Andrew Bosserman have? NASCAR and racing industries, dental and orthodontic industries, or Christmas trees and timber industries. So we'll get to each of those as we progress. So the first question, or it's actually second question, meals and entertainment expenses. Evidently, there's some confusion out there because 11 of the 12 people that voted find the IRS rules to be confusing. So Andrew, this is your shot. Bring some clarity.
Perfect. But one more thing, I want to go back to the amended return, because along with that, we should also talk briefly about statutes of limitations, because that'll affect also whether or not you need to file an amended return. So generally, the statute of limitations is 3 years from the later of the date the return was due or the date you filed your tax return for the IRS to audit and assess additional tax. So for example, if you file your return by the deadline of April 18th, 2023, that's your 2022 tax return, the IRS will have until April 18th, 2026 to assess any additional tax to your tax return. There are some exceptions. Say for a substantial understatement, if you understate your income by 25% or more, that can extend it to 6 years. If you don't file a return, the statute of limitations never starts, or if you file a fraudulent return, same things apply. But for most instances, it's 3 years. So if you find a mistake after the statute of limitations has passed, you might not need to amend your return, probably not, as long as one of those exceptions doesn't apply. But the other important thing to note is that there's also a statute of limitations to receive a refund. So I don't recommend doing this, but I once talked to someone who didn't feel like filing a tax return every year. So what he did was over withheld or paid estimated payments that he thought would cover all of his taxes and then some. The problem with that is that you're overpaying the government, and after 3 years, 2 or 3 years, you can't get your money back. So I don't recommend that, but just be aware that, you know, you can't always get your money back. There is a statute of limitations to file a claim for a refund. And then finally, once the IRS assesses tax, they have 10 years to collect it from you. So that means they can do everything in their power to levy bank accounts, garnish your wages, try to reach settlements with you, anything they can do to collect the tax. But if tax has been assessed and it's been past 10 years, then they can't do anything else. So that's just a quick overview of statute of limitations to keep in mind, you know, if you're deciding to amend your return. But so let's move on to meals and entertainment. And I agree, the rules are confusing. And when I was an IRS agent, this was one of the most commonly audited items I saw, along with, say, car and truck expenses, just because there's a lot of confusion about the rules, but also opportunities, you know, to abuse the rules also if you're looking to, you know, be unscrupulous and save taxes you're not supposed to. But back, you know, 50 years or so ago, pretty much all meals and entertainment expense were deductible, you know, the heyday of the 3 martini lunch and everything like that. But, you know, Congress wised up, and I think in the 1980s, they changed it where you could only deduct 50% of your meals and entertainment expenses. So for example, if you spent $10,000 on meals and entertainment expenses, the rule for, you know, many years was you'd be able to deduct $5,000 on your taxes and reduce your taxable income. But this changed even further with the Tax Cuts and Jobs Act, you know, that was introduced 4 or 5 years ago. And that essentially eliminated all entertainment expenses from being deductible. So the difference, entertainment expenses are things that are simply purely for entertainment. So that would be like taking a client to a Panthers game, or golfing with a client, things like that. Generally though, or like a party just for customers. Generally, those are considered entertainment expenses and aren't currently deductible under tax law, but certain meals are still deductible at 50%. You know, you take a client out to discuss business at a restaurant, that's still deductible at 50%. And then there's also certain expenses that are still fully deductible. 100%, but those are related generally to employees. So say you provide a meal for your employees at the office for the convenience so they can keep working or for other reasons, that's generally 100% deductible. A holiday party for your employees, that's generally 100% deductible. But the rule for the past 2 years, because of COVID, you could actually deduct 100% of your meals in restaurants with clients and et cetera, because Congress wanted to get people to go back out to restaurants, but that has changed for 2023. So this year moving forward. So if you take a client out to eat at a restaurant and discuss business, it will only be deductible at 50%. So that's a brief overview. It's kind of important to think about what fits in the fully deductible, the 50% deductible, and the 0% deductible. And 100% is generally employee related things. 50% is client related meals. And then 0% would be those pure entertainment expenses with clients.
I like how you categorize that. That's a simple way to remember: 0, 50, and 100. All right.
And I don't know if Adam might have further clarification or any other tips, but that's
so there's two areas where there's one's just a clarification and the other is an exploitable gray area. So the clarification, when Andrew was saying, 100% deductible on the employees, I mean, you kind of hear that and you're like, sweet, Gary and I are going out to lunch and deducting that bad boy for the rest of our lives. That's actually not what they're saying. What they're saying is like, hey, Jack, we're all working on Saturday, so we're going to need you to come in on Saturday because we're all here. Where are you? And then I bring some catering in because I asked everybody to be there on a Saturday. That's generally what they're talking about with 100%. That's not called, Gary, let me buy you lunch because it's 100%.
Yeah, they generally use it. Yeah, they generally use the term like for the convenience of the employer, I think. So it has to be like an expense as an employer that makes your life easier, essentially, or allows the employee to work more.
Yeah, and me taking Gary down to Leroy Fox is not one of those, as much as I enjoy it. So
we do enjoy that.
That's the click, because people hear that like, sweet, so it really applies to on-premise meals, for the most part. What do you think when you think about it? Or I took the whole team out to dinner because I made them work late or something like that. So the second clarification on the 110% is, or 100%, the office holiday party, like that also, that still counts. As long as it's not considered extravagant, there's no bright line on what extravagant actually is. So I guess that's going to be however the agent sees it. Now the gray area loophole really comes down to the entertainment expense, because a lot of people are like, oh man, that sucks. I can't deduct entertainment anymore. The loophole when I say it's a loophole, it's just a gray area. The gray area that exists is that, if the entertainment is proximate to a business meeting and a business purpose, then you can deduct it. But there's no like there nowhere in the codes that say what does proximate actually mean. So in most people's heads, proximate would mean, Gary, we're negotiating, a high stakes contract, we actually sign it. And then I say, okay, cool, I've got an extra ticket to the Panthers game. Let's go. That's considered proximate. What's not considered proximate is, hey, Gary, we're negotiating this high stakes contract. We successfully negotiated. Hey, by the way, I've got 2 passes to the Masters next month. Do you want them? That's not considered proximate. So it is an area where, if you try to be aggressive, it's an aggressive spot, because I think as a business owner, most of us would say, with entertainment, it's like discounting. It's like, don't freaking tell me it's unnecessary. You try looking Gary in the eye when he's used to getting Masters tickets from me for years and years and years. When he says, "Hey, dude, got those Masters tickets?" Oh no, Gary, not deductible anymore. Thus, we stopped that as the company policy. No,
I've
Gary
never been to the Masters, just so you know.
Gary still wants his Masters tickets. I'm just not going to get a deduction for it anymore. So, it is an area where, if you can get your fact pattern to fit, you have a case for the proximate clause, but it's just be careful. And I'll also say on the proximate clause, I haven't been challenged on that, so I haven't had to defend it yet, because that the disallowance of entertainment is relatively recent. And what's interesting about that is that if I go back and think about it, BGW has not had a client. This goes back to this, still trying to hire 87,000 people. I don't know about you guys at Shoemaker, but we have not had a client be audited since that for a year where that went into effect and had entertainment be an item. So just it hasn't been an area where we've had to prove anything, because although we've had people get audited, probably the most recent was 2019 is the most recent year we've had somebody get audited, but not calendar year 2019, but for the tax year 2019. But that this is also new, that it hasn't been an area that we've had to defend or support. So it's also just a way of saying, hey man, I know what the rule says, but I don't have any tax court cases to reference back to yet. And I haven't been audited on it yet.
Hey, we got a question that came in here regarding statute of limitations. So the note says this: thanks, Andrew, for the clarification on statute of limitations. You mentioned after 10 years, the IRS collection efforts will stop. If the tax or penalty or interest was from 2012, then 10 years out would be 2022. Is that to say that once you get past calendar year 2022, then 10 years have expired? Or could it be one more year since the following years when the return is done and due? Make sense?
All right, Andrew, before you answer, I'm going to be the free legal advice police for just a moment, which is, thank you for the details of that, but there are, there are other things that might impact that particular scenario if it's more than hypothetical. So just keep in mind that we're providing friendly advice, and that, if there's something specific, then we're happy to look into it. But okay, Andrew, you may proceed.
Yeah. So the 10-year rule I gave you was generally 10 years, and it's going to start running when the tax is assessed. So that's either going to be if you were audited and when you actually signed the agreement, agreeing to the additional tax, or if you filed your tax return, it would be like when that tax return is filed, or the later of the due date. So if you're looking at the tax year for the tax return is probably not going to be correct, because you need to look at essentially when the tax is assessed, and the 10-year period starts running from that time. However, there are exceptions when the IRS can pause the statute of limitations. So for example, if you ever declared bankruptcy, the collection statute pauses during that time. Or if you ever try to request an installment agreement with the IRS, or an offer in compromise, which essentially is negotiating a settlement of your tax bill, that pauses the statute of limitations, and other things can do so as well. So that essentially just pauses it, and then the IRS can pick back up once that is resolved. So 10 years is general. It can be paused and restarted. So the IRS can have more than 10 consecutive years to collect in certain instances. And also sometimes the IRS might just get the statute wrong. So just because the statute has expired doesn't mean they might not try to collect it, but they just legally, can't collect it from you.
All right, cool.
In my experience, that we've only had one client ride the statute out. And I gotta tell you, like people that hear this like, oh, wow, I just saw a commercial for Optima tax relief. I can negotiate my tax debt or ride the class. So first off, again, maybe Andrew or Jack has had a different experience. The number of times where the IRS has said, oh man, I feel so bad for you. That's awful. I know that you totally were supposed to pay this tax, but now you can't. So we're going to settle the tax debt for 25 cents, 0 times, nor have I had any clients that used a tax negotiation service that actually were successful in that process. So going back to the ride the statute out, I mean, this is what this guy's life looked like. Could not have a bank account because IRS will find it. No access to credit because he's got liens all over the place. Couldn't, had to go through the whole, hope you trust your spouse because everything needs to be in that person's name, because otherwise, when you go to sell that house, there's going to be that nasty little lien attached to it, that's called settle the debt. So, I mean, you basically are not able to have a functionally financial life for 10 years. And it's like, while getting out of the debt sounds really good on paper, try before you make that decision, try going a week without having any sort of financial life. Because that's effectively what you're signing up for. In addition to, they may come knocking on your door at any point in time.
Yeah, that's a good point. And the IRS tracks the statutes very, very closely. So, I mean, agents and collection agents get lists all the time of where all taxpayers are in the statute. I remember when I was an agent, you'd get a statute list every time. And if you even got, within 60 or 90 days of statute of limitations, they, were trying to get you to resolve the case. So, the IRS is well aware and they'll do everything in their power to get it from you before those 10 years generally.
So here's a question, Andrew. This is not in our polling questions, but it's a curiosity. Are IRS agents incented, like, are there bonuses or anything like that based on ability to collect?
There are not. When I was an agent, there wasn't, and I don't think there are anymore. I have heard from older agents when I worked that there used to be certain bonuses or incentives depending on assessing tax, but obviously that gets into some, moral hazard issues where, agents are probably more likely to be less reasonable or assess additional tax where it's not warranted. So I have heard they used to do that in the past. I can't, I don't know if that's actually true, but currently there isn't any bonus or incentive, kind of just for those reasons I mentioned.
Okay.
Yeah, I'll say also based on my experience is that, it's better than 50%. It's not better than 90%. So it might be, the true answer might be 60-40, maybe it's 75-25. The majority of the time, the agent is reasonable, meaning they may seem unreasonable to the taxpayer, but from my perspective, they're being reasonable in what they're requesting. And it's like, well, I don't want to have to provide, dude, the guy's just doing his freaking job. I mean, like, that's what they're required to do. Like, don't get all freaking huffy that they're asking for 12 years worth of bank statements. Like, they're trying to prove that you did not hide money. So let's just prove it to them. So that, and when you're kind of in a gray area, they're pretty, I'll give you a good example. Had a client that had, sold some gold that he inherited. So he had so first off, he didn't report the transaction because he was an idiot, thought that he didn't have to. And then secondly, he inherited the gold. So he had to step up in basis in the gold. You know, jerk move would have been, well, if you can't prove to me what your basis was, then the answer is going to be 0 for you. What the agent actually did is like, okay, I can buy that, show me that he actually inherited the gold. Check, we did. Help me establish the date of death. Help me, what was the date of death? Check, we did. Can we just agree on the spot price of gold at that point in time as his cost basis? Sure, we can. Very reasonable as a response. So most of the time you kind of get a person like that, but at the same time, it's sort of like, are there police officers who are sadistic? Yeah. As unfortunate it is. And I will say that, 25, in between 10% and 25% of the time, you get somebody who's like, my day sucks, therefore I'm going to make your life suck. I'm going to be intransigent, on this, in which case, there are appeals processes that exist for that reason.
I can't hear you.
I couldn't hear you.
Oh, sorry. I turned off my mic. I was coughing.
That's okay.
So we're going to go ahead and skip ahead to the last question, and then we'll finish with the dirty dozen, as many as you can cover. I am curious about who co-authored one of them or some of them. So, yeah. Anyway, so survey says, most people think that you have expertise in NASCAR and racing industries. Second is dental and orthodontic. And the distant third is somebody that went onto your LinkedIn profile and found out that you actually have expertise in Christmas tree and timber industries. That's pretty interesting. I did not know that before I went and checked you out on LinkedIn. So anything that you want to add?
Cheating. That's cheating. So no Starbucks card.
I did, but I created the poll.
Yeah. So back when I lived in Ohio, I actually owned my own Christmas tree farm for a few years and operated it. So small Christmas tree farm, but that's how I started learning about, there are actually special tax laws in the Internal Revenue Code that deal with Christmas trees. But they also they classify Christmas trees as timber. So that's how I got into the timber industry, because I learned about the Christmas tree aspect and then learned how to apply to timber as well. So I've spoken to lots of forest landowners. There's a big North Carolina Forestry Association I've spoken to a number of times, and yeah, it's a niche I enjoy working in, and it's different from other day-to-day tech stuff.
Yeah, I think that's interesting. So Jack, you've raised your hand.
I have. So this is not free legal advice. This is just free home advice that I'm asking for. But what is the best way to preserve a Christmas tree so that it doesn't get all dried up before New Year's? Yeah.
So the first thing, we talk about the 3 freshes. So first of all, you want a fresh tree. So this, means, oftentimes if you can go to the farm, which my family and I enjoy driving up to the mountains every year, cut it down yourself, it's fresh. Or if you're going to a lot, just feel the needles. They shouldn't, come off in your hand. They shouldn't be brittle. They should be pliable, and it should seem fresh. Also, right before you put the tree in the stand, you want to make a fresh cut on the trunk, because after it's cut off, within probably 20 minutes or so, it's going to start kind of sealing back up with all the sap, and that's to preserve it. But you actually want the tree to take up water, which is the third item, fresh water. Make sure you keep watering the tree in the stand, putting fresh water in, especially in the first week. Oftentimes it drinks a lot. Another thing is to keep it, if there's a heat vent nearby where you put your Christmas tree up in your house, close that, and just keep it away from any heat sources. But if you're getting a Fraser fir, like most Christmas trees are in North Carolina, they can last a long time as long as they're properly cared for.
All right. So some follow-up questions. Myth or real. Drilling holes into the trunk at angles so that the water just doesn't come in through the bottom. Is that true or not true?
I think that's a myth. As long as there's a fresh cut on the tree right before you put it in, you keep it filled with fresh water, holes shouldn't make a difference.
Okay. And what about putting a block of wood so that the trunk doesn't maybe get all the way down to the base? And so it's elevated a little bit. Is that true or myth?
I mean, that might help, but most Christmas tree stands, they have like spikes on the bottom so that it, sits on top. So it's not completely touching the bottom. So I think most stands are designed anyways to keep that. But if you did an instance where it was sitting flush on the stand, then you might want to try something like that.
Okay, so my takeaway is I need to get a different stand because mine doesn't do that. And so I have my teenage children holding the tree up so that way the spikes that go sideways can get it before it goes all the way down. So now I know.
Yeah, sounds like you just need a Christmas tree stand.
Okay, and thank
Who
you for
would've
preventing a
known?
fire hazard. That is also a fire hazard at some point. A dried Christmas tree. So thank
Yeah,
you.
you would be surprised. I've talked to people who had no idea they needed to water their tree. And if you're out there, if you're out there listening, we won't make you raise your hand if you know that too. You don't have to confess to that. I'm the one confessing today. But
That's
just
right.
make sure you fresh tree, fresh cut, fresh water.
Okay, and I think that's the substitute for dumb crook news for today.
Yeah, that I'm so glad that you came and joined us because that was really good. I learned something, even though I have an artificial tree and have for a while. But
Oh, another fun fact, because you brought up the artificial tree. Did you know that the first artificial Christmas tree was invented by a toilet brush manufacturer? Because if you think about it, it literally looks like
really?
a toilet brush in your living room. They just dyed it green and figured out a new revenue stream.
Happy holidays.
Yeah.
Was it the Fuller brush? I used to do work with Fuller brush. Remember those guys?
I'd have to look it up, but yeah.
Yeah, that's interesting. Okay, so now we know. Let's talk a little bit about some of the dirty dozen, some of those scams and it seems like the IRS kind of updates that almost on an annual basis, crypto, some of these other things that have come onto the scene. So kind of confessionaires choice. Which ones do you want to highlight, Andrew?
Yeah, so the IRS does update this yearly, and kind of the theme running through these is oftentimes these scams take something that's legit, but then people get greedy or for whatever reason, make it into something that isn't legal anymore. One of them, and kind of what's been at the top of the list, and it's something we've talked about on here before, is the employee retention credit. There's a lot of shady firms out there currently that will promise you a big refund, and you probably don't qualify for it. The two ways to qualify are a substantial decline in gross receipts, or if not, there has to be a government order that had more than a nominal impact on your business. That government orders test is where a lot of times these firms will say you qualify when the test is actually a lot stricter than they might be telling you. So that's one of the things that appeared on the Dirty Dozen list this year. Another one is be careful if you have any, they talk about offshore bank accounts or cryptocurrency or digital assets. If you've noticed the past few years on your tax return, you actually have to check a box saying yes or no. Did you sell any cryptocurrency or other digital assets? And the law is currently, being, I guess, figured out with regards to digital assets as we speak. But selling a crypto or any other digital asset, an NFT or something like that, is going to be a taxable transaction. So be aware of that. Even though a lot of times these firms may not have a reporting requirement to the IRS. If you hold your crypto through, say, a broker like Coinbase or something like that. Another one that has come up before. It's known as a monetized installment sale. And this is something, so installment sales, you've probably heard of that. It's essentially when you could sell your business or you could sell a piece of property and you receive payments over time. Essentially, it's seller financing. And the nice thing about that is you don't have to recognize all the gain up front. You recognize gain as you receive the payments. So for example, say I had a $10,000 gain on selling a piece of equipment and I take payments over 5 years. I would essentially recognize $2,000 of gain for the next 5 years. So it spreads out the gain and out, I can pay the gain over time, which is nice when I receive the payments. But the monetized installment sale takes it a lot further. And the issue with that is it's a transaction. There will be brokers or promoters out there that will say, oh, we'll do this, you'll get a deferral, but I'm going to bring in this third party who's going to loan you the entire amount of the funds up front. So you can have your money. It's like you can have your cake and eat it too. You can get all your money up front. You can recognize the gain over time, but then, you have to then pay back the loan or something. But that runs afoul of a number of things in the Internal Revenue Code we don't have to get into. But just beware, if it sounds too good to be true, then, probably is in the case of an installment sale. Another one that comes to mind is syndicated conservation easements. So a conservation easement, in and of itself is a great thing. You can donate a conservation easement and get a charitable deduction. And what a conservation easement is saying you're giving up the right on your property for it to be developed. So generally they can vary with what exactly they say, but essentially you are, it's for conservation purposes. Maybe you have a large piece of property and you don't want it to be developed, and you also would like a nice, tax deduction. You can actually donate and they figure out the value of giving up that right to develop the property, and you get a charitable deduction. But what happens in these syndicated conservation easements is essentially these promoters get together, buy a piece of property, find a bunch of investors, and then they radically inflate the value of the property or the easement they're giving away. So the issue is that these people are kind of, way inflating the value of the easement that's being donated. And then, it's not legit, and in order to create a bigger charitable deduction. So, beware if you're ever approached by someone, say that you can invest a certain amount in this thing and get a much larger tax deduction. That's probably not the case. Let me see, let me look through the list, see if there's anything main ones I'm not thinking about. Those are the main ones. I mean, always beware. There's always things on the list about, phishing, meaning people sending emails purporting or calling you on the phone purporting to be an IRS agent or something like that. There's so many identity theft or other types of scams. Generally from the IRS, you'll only receive correspondence in the mail letting of an audit or any issues. And also if someone calls you on the phone, you can always call the main IRS number that you can find on the internet and verify anyone's identity, because all IRS agents have a badge number they're required to give you whenever you speak with them. But I mean, the main takeaway from these dirty dozen is that generally if it, sounds too good to be true, it probably is, and especially with taxes, because the IRS, figures out these loopholes and oftentimes closes them.
Yeah, man, this has been good. Very good. Any additional questions out there from the gallery? Had a nice crew on here. I had 29 at one point, down to 26 right now, but that's pretty good. For anybody that did come on late, if you have questions, hit us up in the Q&A. We made an announcement on the front end of this thing. So April 20th, we have a few slots left for the talent retention strategies, where we've got a speaker panel, including Charlie Maloof, CEO of Ashley Home Stores, Patty Comer of Accrue Partners, and Kevin Monahan. And then we'll be kind of emceeing that. That's April 20th here at BGW. It's in the morning. I think it's at 9 o'clock, something like that. Then April 25th, if you want to participate and have the $99 fee waived for dialing in your sales with Jim Dunn with Sandler, as well as who else do we have on that one? Dan Flaherty, sorry. Dan Flaherty is really good. He used to be like head of global sales for a division of GE, but he has a fractional CFO, or I mean, head of sales thing, and he's got a number of them, a number of people that work for him doing that, and they were all accomplished salespeople. That's going to be really good. So that's April 25th, and also we'll have more about this, but this is pretty cool. The founder of Reebok is going to be coming to Charlotte, and it just got finalized. They had to change the venue, but it's going to be at CPCC. Joe Foster. This is an amazing book, really amazing. He's 88 years old, and he looks like he's about 70, and he has the energy of probably a 30-year-old. And so, but his story is really amazing. So he'll be speaking at CPCC, and I will be kind of a warm-up speaker and talking about a little bit of my story, but more about imposter syndrome, because I see a lot of CEOs that deal with that, believe it or not. And then also Manny Ahome, who is the CEO of Samaritan's Feet, and his story is amazing, just amazing. And if you haven't listened to it, it's on the Anything But Typical podcast that we just launched his episode last week. So anyway, some good stuff. That's May the 4th in the morning, I believe, at CPCC, and they've got a new auditorium in a student center that holds, I think, 430 people. So they're going to have half of that room for students, and then the other half for businesses and business owners, so they can interact with some of these business students, et cetera. So that'll be a pretty cool community thing. We will put this thing up on the BGW CPA YouTube channel later on this afternoon. Any other questions? Kind of last call. And while we're waiting for last call, any comments, Jack or Adam or Andrew?
I'll just remind that we have a Shoemaker YouTube channel as well that has some of the stuff that is not what's the word I'm looking for? Timeless. That are not like, so the PPP stuff is not on there because it's done. But and then also I was thinking that I'm going to put the Confessions of an IRS Agent onto Andrew's, or maybe I'll put the whole entire library on Andrew's bio as well. So
good.
You have another source of accessing those as well.
I think that's great. Yeah, that's one area that our YouTube channel, we have got to clean it up better and actually do the same and get it going for the Anything But Typical podcast, because that's been 3+ years. We've had amazing CEOs. Their stories are amazing, but it's always on any of your podcast channels, but we need to do our YouTube and get that moving. So Andrew, thank you so much. Oh, here we did get a question coming in here. Can we get a list of those events from the YouTube channel on the April 20th, 25th, and May 4th? I don't think we have anything like that yet. What we can do is I'll work with our team and see if we can just do a reminder for anybody that was on here. Chris, thank you for joining us. We appreciate that. So Tim, I'll make sure that Rachel Coughtry and our marketing team get back with anybody that's been on these last couple of our webinars, just so that you guys know what's going on with these events. And we'll talk about them again next week, just do a reminder. All right. thank you all for attending. I hope, oh, good. Jack is now out of jail. And he's got I thought that was our Myrtle Beach office, because Tanya Steele always uses that background, but I guess it's not. I haven't seen all those palm trees at Myrtle Beach.
Yeah, it was too dark in here. I didn't want people to leave the impression of the darkness of a jail cell,
Yeah.
and or be concerned for my safety or well-being. So I'm okay.
You're good like that, man. Adam, any last thoughts?
Yeah, I'd like to point out that jail cells actually aren't dark. They're actually very well lit. I'm just going to leave it at that and let people.
That's true, except if you
wonder
go to
themselves.
Alcatraz, it's
Yeah. That's old school and closed.
Yeah, that's true. That's worth doing if you go to San Francisco. Just make sure that you're really careful walking the streets of San Francisco these days. But Alcatraz is a great excursion.
Make sure you get your tickets like months in advance. Don't think you're going to show up to San Francisco and get tickets to go to Alcatraz, by the way.
That is true. That is a true statement. It's worth doing. All right. Well, Adam, wherever you're going, you be safe. I'm going to Kentucky. Go see my little Rugrat grandchildren. So that'll be fun. So we'll see you guys next week. Again, Andrew, thanks for being such a good sport. You've been on here so many times and it's always valuable. So we really appreciate that. Jack and Adam, it's always fun having you guys. Again, this will be up on the YouTube channel later on this afternoon, and Shoemaker has their own too. So thank you, everybody. Have a wonderful rest of the weekend. Bye-bye.
Thanks. Bye.
Bye-bye. Thanks, Gary.
Bet.